Hello everyone, this is Professor Kent. Today's recording is for Chapter 6. On Chapter 6, we are going to be talking about a business income, and then we are going to be moving to property income. So that's where we're going to be moving to Chapter 7. So when we're doing it, for this chapter I'll be doing 3 recordings. So I'm going to break the chapter into 2 recordings, and then one recording will be for the homework. I'm going to try to do it as fast as I can, but sometimes because I'm in the classroom, it takes me longer to record the video. I know you request it, but then sometimes I don't get to it quick enough for you guys. So we are going to be talking about chapter 6. Chapter 6 is the importance of a business. So why is the business is important? So now the importance, why is it important? To determine, is business exist, means is there a business? That's why it's important. So any expense that are created prior to starting a business or after ceasing, is after you close your business, are not deductible. Any expenses before starting the business and after closing the business are not deductible. And there's a different at the year that you seize the business, the year you sell the business, there's a different treatment when you sell the business versus as a sale part of the business. When you sell the full business or you sell part of the business, there's a different treatment, and we're going to be talking about it. Now, when we think the other important part of determining the existence of the business is the business activity. What type of business you are going to be doing, or the sale of a property, and when you sell a business, the capital gain treatment. Whether the also important, whether the nature of the activity carried by. It is important to know who owns this business. Is this a non-resident, resident, or resident or a non-resident who carries the business? If an individual is an employee, or it is a self-employed carrying. So now business can be run by individual who is an employee. So you could be working for yourself. So you're a sole proprietorship. That's what it means. Or you could be self-employed. Self-employed is you're not getting paid from the company, but you're running the business. So what includes under this, define when you do have a business income? It includes a professional income, calling, trade, manufacture, or undertaking any kind of activity will be a business. So there's a difference between the business versus an income from a property. So there's 2 separate incomes. You're going to have a business from income from business. You can have an income from property. 2 separate source of income. There are 2 different source of an income, but but under a same rule. So same rule applies to both, to the business income, to the property income. They both come under the subsection B. For the tax, of course, the same rules for reporting an income. So, but there's a different tax treatment. The tax treatment is different under the business. So business income is an ongoing and a continuous activity, little or no activity under the property. So what happens is you bought the property, you invest the property, and that's it. So now when we think of a commencing is when we are starting our business, when we're starting a business. A business is considered to have commenced when some significant activity. So if there's an activity is undertaken, your business is started. So you started the business. Then there is an essential primary step taken. Now you might have to take a license to start a business. So that is an essential preliminary step. So this is our first step, is to get a license. So obtaining a licenses. A person is committed to course to a course of action and actively taking a step to create a necessary business structure. Your business is started when you're creating a necessary business structure. Note any expenditure that are incurred prior to commencement are not deductible. So remember that if you have an expenditure incurred prior to commencement, they are not deductible. Your business has to start in order for you to have your expenses taken as an expense. Now, the losses disallowed on the basis if the business does not have any income, if you don't make any income, any losses that you have are disallowed. Disallowed means you're not allowed to create losses if you don't have any income. Now we could have when you think of a residential property is the property that you live. That's what happens. So now these rules changes as of January 2024. Main legislative rule that applies when a taxpayer dispose or a flipped property. Now sometimes what happens is that you buy residential property and then you sell it. You buy it and you sell it. Then what you're doing is, this is what happens is you're flipping the property. This is where the rule came in that the government did not wanted you to flip the property flip the property to create a gain. Remember in a little while ago, a couple of years ago, a real estate property went up in a price. So if you have a residential property and you were disposing it, you were flipping it for a profit, it's disallowed. What happens is that they put it in a rule. It's saying flipped property defined as a housing unit situated in Canada that was owned less than 365. So if you before its disposition were not already considered, it's not already considered to be an inventory. So what happens in this case, what you have to do is you have to hold it for 365 days in order for it to be residential property. If it's not held for 365 days, then what happens is that it will be a normal business. So that's what happens. Now going further, if a taxpayer dispose of a flipped property at a gain, the rule deemed a taxpayer throughout the period that what they do is to have a carried on a business that adventure or concern in nature of a trade. So we think of it, you're buying the houses to flip. So your business is to buy the house and sell it for more price and you're going to have a gain. So then what happens is that is treated as a business income, or this gain is treated as a business income. If you have a loss, you cannot claim this loss. So in other words, if you sell it for more than what it costs, you're gonna have a gain. If you have a gain, government wants the piece of that pie. So it will be not recorded. It will not be a principal residence. Principal residence, we don't pay any taxes on the capital gain. There's no, even though you have a gain, we don't pay any taxes. But if you're flipping the houses, then we have to pay the taxes on the gain. Now, what happens is source of income and categorize of a property. Type of a property contemplated by source of income. So you have a property and we want to know what will be the source of income. So what happens is that if you're buying the house to sell, you're flipping the house, it will be part of your inventory. If it's a part of the inventory, you could have a gain or a loss on sale, treated as a business income or a business loss. 100% is included in the income, 100% it is deductible if the property is, if your attention is to buy the property and to sell it. Now the other one is when we think of a depreciable property from the part of income. So this part of income, if you're depreciating your property at the time you sell it, you are going to have a recapture or you could have a terminal loss, or you could have a capital gain. You can have all three. So when we did it, when we did the last chapter, chapter 5, what we did is we learned about if you depreciate a property, you can have a CCA, you could have a recapture, you could have a terminal loss, or you could also have a capital gain. So go back and visit chapter 5 if you're having a problem with recapture, terminal loss, and a capital gain. You could have you could have a property that are non-depreciable. If it's non-depreciable, at the time you sell it, you're only going to have a capital gain and loss. You will not have a recapture or a terminal loss. Going further, it's saying business income and losses. So what happens is, this is just an overview. So what act do they go, or where do we put them? So which division do they go? So any profit from a business or a property, it is included in the income, subject to according to Income Tax Act 9(1). And then under 2, we have a when a business or property losses determined using ITA rule that had the rules had been there a profit before. So here, if you look at it, we only have a profit. Here you have a loss under this. So we have a profit, and then we have a loss. Here we have an income or a loss from a property, excluding any capital gain and losses, which will be separately reported under subdivision C. So you have a capital gain, or you can have a capital gain loss, will go under subdivision division C. So under the Income Tax Act, profit is not defined. When we think of accounting, we think of a revenue minus expenses is your profit, but in the Income Tax Act, profit is not defined. So how do we know what is a profit? Profit is a question of law, not an accounting. GAAP are not rules of law, but what we do is it helps us aid those rules. So profit, when we think of it, you produce our income statement using a GAAP principle, but they are not law under the income tax. So what we do is, now when we think of rules or general rules, when we think of general rules, reconciliation of accounting income to an acceptable amount for income tax purposes is a function. So any addition to the business or a property goes under Income Tax Act 12, and your deductions to reduce that income are limited or restricted under this act. So we're not allowed to deduct all the expenses or there's a limitation. So we're not allowed to deduct all the expenses. So there is a limitation. And under this, some deductions are permitted and some are not permitted. When we think of what are permitted, what are not permitted, we think of a perfect example will be meals and entertainment. When we think of meals and entertainment, we think of only 50% is allowed. So this is an example, and it's a summary of it. You have an income, so you have an income, and then what we have is income. Where do we get this income? This income is produced using a GAAP principle. So we use the GAAP principle to calculate my income, and what we're doing is we add back what is not allowed. So whatever is not allowed, what we add it, and what we are allowed, we deduct them. And then what we did is we calculated net income. This net income is calculated using an Income Tax Act. When we think of income, it is produced using any GAAP principle, but a GAAP is not recognized under the income tax. If it's not recognized, we need to adjust that income. when we think of a business income, when we think of accounting, we use accrual basis of accounting. And what we needed to do is convert this in business income into cash. When we convert it into this business income into a cash income, and that's when we talk about we pay taxes on it. Now when we think of it accrual basis, when we think of accrual basis accounting, amount received or receivable, we think of it, we pay taxes on the money that we received. So you sold an item, and we don't think of an accounts receivable. We are going to be talking about reserves later on. We think of a cash sale. So we convert that sales into a cash sales, and then we pay taxes on it. Now applies to sale of a product. So you could be selling a product, or you could selling a service. An amount is deemed receivable at the earlier of the day that the amount was sent, and the amount would have been sent with if no undue delay. So if you send them an invoice, or you're going to be sending them an invoice, that will be part of your sale. If any money that you received in advance, if I think of an accounting, you debit the cash and we credit the unearned revenue. That's what we do. And from the accounting perspective, when we think of from the income tax, amount received in advance included in the business income, that's what it is, and the products are delivered in the subsequent year. So that's what happens. What we do is we include it in the business income, even though we are going to provide the service or a product in the subsequent years. So now you will be allowed a reserve. So this is, you will be allowed the reserves to offset the amount that you received. So we received money, so we haven't earned this revenue. So of course income tax when we pay taxes on the cash. So when that happens, we are allowed to do reserves. When we do the reserves, we are allowed to it is not a mandatory, but it's an option. We are allowed to reserve, so we can reduce our business income. That's what our reserves are. So what happens to our reserves? So it is included in the whole amount received, so in advance. So included the whole amount received in the advance, so in the income. So whatever you received, we included in income, but we're allowed to deduct. What are you deducting? In one period it must be included, and the other period we have to we deduct it. So what happens is, if we added all the income in our business income, we are allowed to deduct it, and the following year whatever we deducted, we are going to be adding it. That's what the reserve means. So one year you deduct it, the other period you include it. So what happens is, it has to be deducted first in order for us to include it. If no reserve is allowed on the amount, if it's already been earned, so there's no reserve. Only if you received something in advance, you're allowed a reserve, because you add this to it. If you received in advance, you add it to the business income, you're allowed a deduction, and the following year you will have to include it because you will be receiving that money. So now when we think of it, under the reserves, what the rule prohibits means doesn't let you prohibits deduction for accounting reserves and contingency liability. We have to add them back to the income to reverse the income tax impact. So what happened to contingent liability is a liability we report as an expense and a liability. That contingent liability, the impact of the liability, we don't know till the future. If that happens, we needed to add back to the income the contingent liability, any accounting reserves that we have, we needed to add back. So now we have something called installment. So so we call it when the business sells an inventory excluding the real property with a part or all the sale price are not due until at least 2 years. So what we have, what happens in this case, you sold something, you're going to receive money in installment. We call it installment sale. So what happens, we're allowed, because we're not going to be receiving money and we're receiving money in installment, we are allowed a reserve for that. If we're allowed a reserve, we needed to calculate this reserve. How do we calculate this reserve? We first find out the gross profit percentage. How do we calculate gross profit? Divided by the gross selling price. And what are you going to get? You're going to get a gross profit percentage. And then what we're doing is we're applying this percentage to the unpaid amount at the year end. That will be your reserve that you're allowed. So you're allowed that reserve. And this reserve is only allowed if you, it is limited to, what is it limited to 3 years. So we have, it is limited, there's the limitation of this reserve. What is that limitation? Limitations are 3 years, sale of the year, and the 2 installments that you're going to have. So that's what the limitation is. Now going further, we have is limitation on deductions from business and a property income. It is important to identify which expense have been claimed as a part of the profit that are acceptable and those are and those that are not. So you have to think of it as if it's an expense that is part of your profit. We have a revenue minus expenses, which we have we call it profit, and there we have some expenses that are not acceptable. So we needed to know which are acceptable and which one are not acceptable. You have to figure that out. So under the 18 can block the ability to deduct expenses from the business or a property. Some of the expenses we are not allowed to deduct them. However, we can override 18. So where we were blocked here, what we allowed a deduction under a different act, and which we are call it Income Tax Act 20, and may provide specific deduction based on what is acceptable under. So if you have something that you weren't allowed to deduct under 18, you will go into 20 and say that, am I allowed some of the deduction that I wasn't allowed under 18? Am I allowed to do that deduction? If you're allowed to do that deduction, and you should do that. So that's why you need an accountant to do your business return, because an accountant knows more about the taxes than an individual. So it's always good to get a help from an accountant who is practicing an accounting. Now when we think of a limitation of income tax 18, income tax rule 18, ensure expenses are sufficiently connected to the source. If the expense is connected to the source of income, then that means, of course, source of income, that is a business of a property, you will be allowed to deduct it. Would this expenditure have been incurred in absence of a business property? You needed to know if this is an expense that is allowed or not allowed. So you have to ask yourself a question. This is an expense. If it's an expense, it's an expenditure. Would this have been incurred in absence of a business? So if you think about it, if you didn't have a business, would you have this expenditure? If you would not have that expenditure, that is connected. If you would, that means it's not connected. So would and would not, right? So this is what the question is here. What is a motivation or intention of you having this income, this expense? Is this expense to earn an income? If it's to earn an income, it's allowed. If it's not, then it's not allowed. It's no personal element. There is no personal element, means you did not incur this expense for your personal. Example will be recurring business expenses such as those for office, administration, salary, rent, and advertising. If you don't have a business, you're not going to have those expenses. If you're not, that means you are connecting these expenses to the source of income. If you're connecting it, you are allowed to deduct it. This is a summary of some of the capital expenditures that the company can have under under income tax 18 and subsection 1 under B. So what is included? No deduction for capital expenditure. Now this is a summary. So now capital expenditure, what is it include? The cost to acquire or improve a capital property, cost to create a business structure, cost to add and acquire existing business. Note, cost to maintain an existing business structure are not a capital expenditure. So these are not capital expenditures. So what happens is capital expenditures are what they are. They are cost to acquire or improve a capital property, cost to create a business structure, cost to add and acquire a business structure. They are capital structures. If you want to maintain it, they are not your capital structures. Now, if you are unable to claim it under Income Tax Act 18, you are allowed to deduct it under the 20. So it may contain a specific provision to allow deduction for a capital expenditure. If you weren't able to deduct it under the 18, you will be able to deduct it under the 20. Now we have something called personal and living expenses. Everybody has to live, right? So we have a household expenses. So there's no deduction for personal or living. So there's no personal or living. The definition of personal or living includes, what does that include? Expenses related to your home, to your cottage, your vacation property, your life insurance property. So these are expenses. These are called personal or living expenses. Expenses are not connected to source of income. If they're not connected to source of income, you are not allowed to deduct these expenses. Now we have a recreational recreational facilities and club dues. So you as an individual, what we do is we are allowed to enjoy ourselves, and sometimes what we do is we play golf. So in this case, we are part of the golf club, and what you're going to do is you're going to be paying them the membership. If you pay the membership, this is not a deduction. Why? Because you're not generating any income when you're playing golf. If you're not paying income, you're not paying taxes to the government, and the government says that you're not allowed to deduct the golf club dues. So these are your membership fees to the golf club, dues to any club that maintain a purpose of, or which provide a dining, sporting, or recreational facilities to the members. So if you're paying those membership due because of these, they are not deduction. Now going further, that what we were allowed before, and it's not allowed anymore. Safety deposit box fees. You have a jewelry, you have a lot of gold, or you have a lot of let's say money that you put it in the safety deposit box at the bank, and the bank will charge you for the safety box. There's no deduction for that. In other words, you could keep it at home, or you could put it in the bank. If you put it in the bank, you pay the safety deposit box fees. That is not deductible. Political contribution. Now the elections are coming. If elections are coming, you are contributed to a political contribution. There is no deduction. However, you're allowed a credit. We did talk about it in chapter 4 when we talk about credits. Now we are going to go further. I'm going to do another recording on that. I'm going to stop at this point. I'm going to do a part two recording for the second part, because we have another 24 mile slides to go. So I will record another part 2 for chapter this is chapter 6. I will have another recording for chapter 6. Now thank you so much for watching, and thank you for being patient and watching my videos. Don't forget to subscribe. Don't forget to tell your friends to subscribe to my channel. It will help me a lot. Thank you so much for taking the time to watch my video.